market. Can we just show an intraday here once again, or at least the current picture of the three majors, because we continue to have a bit more pickup in the activity today in stocks. NASDAQ's good for more than 2%. There you see it, 2.13%. There's the S&P 500 trying to get back towards 6,000, and the Dow is up 1.5%. We told you we were going to focus with our resident expert, Jenny Harrington, on dividends because investors have high hopes for 2025 following a year that modestly underperformed the S&P 500. Jenny Harrington among those who are optimistic coming into this year. Debating dividends was the focus of a recent segment we did with Josh Brown, who questioned whether using dividend investing as a sole strategy was a good idea. Listen.
I am pro-dividend. 75% of companies in the S&P 500 do pay a dividend. But when you actually analyze it as a standalone factor, 54% of the time, it trails the performance of the S&P 500 over all 12-month rolling periods going back 30 years.
Part of the point he also made was that companies have changed the way they return capital to shareholders, focusing more heavily on things like buybacks, which end up helping stock prices more. Plus, you risk missing out on great companies like an Amazon, for example, or Berkshire, which Josh owns, both, obviously, and they don't pay dividends. So I wanted to get your take on this because, again, you are our expert, okay?
Right.
And I know that there are a lot of people watching who buy stocks for the dividends.
Right.
So what's your, not so much defense of dividend investing, but why this works and who it works best for?
So to be really clear, it is not for everyone, right? Most people don't need income. But if you do need income, it works really, really well. And that's a pretty niche strategy. Like sometimes it's a retiree, sometimes it's just someone who likes to see some component of their total portfolio rolling in day after day. At least in my case, most of my clients don't have 100% of their portfolio in the dividend income strategy. So they're not missing out on an Amazon or Microsoft. It's just different silos. And frequently people use it, again, for that silo to replace the income or to diversify their overall portfolio. You know, when we let in and we said, investors are looking towards 2025 as a good year for dividends. I think the reality is, and this sounds silly, but I think every year is a good year for dividends. If you are a dividend investor, you know you're getting your income, right, and are in a good strategy, a well-managed strategy that's consistent, that looks for consistent dividend income. You know that's coming in. And what's really cool is S&P 500 dividends since like the last 50, 60 years have grown at about 5.7%. So if you need that income and you want that income to outpace inflation, it's doing that. I've found the same for my strategy, which isn't S&P specific. In addition, you have a tax-advantaged income stream. If you buy treasuries or corporate bonds, you've got an ordinary income tax. Dividends, you're getting a 15% or 20% tax rate on them. So you have all these wonderful things going for you. But the thing about all that is I think what we all know really well here is the single best investor is one who behaves well. And you can be in high growth, but then if you freak out at the wrong time, if you switch strategies at the wrong time, it can destroy years of good returns. And generally, what happens for dividend investors is they get really hooked on the income. And they know if they sell, even if it's a March of 2020, or a late 2022 when the market's down, or in October of 18, they know if they sell, they're cutting off all of their income. So that consistent income stream leads to very good behavior. It acts as a huge emotional source of comfort for investors. So all of those things people have going for it. One of the other things that Josh talked about on the show the other day is, what kinds of companies pay big dividends? And sometimes it's stocks like UPS, like we talked about before, where the share price is off its high and then you have a high dividend. But there are a lot of companies out there too where actually that return of capital decision is saying like, look, we don't have huge growth opportunities ahead. We just have really high free cash flow. And let's make that our return to shareholders. Let's incentivize shareholders to buy this. So if you look at Ares Capital, right, Michael Arangetti's been on the show a lot. He's unbelievable. That's an 8% return. He doesn't say to shareholders, hey, I expect this stock to double. He says, no, you're going to get this 8% return. And that's our goal, is to give that to you when you buy ARCC. In my portfolio, I have Enterprise Products, one of the midstream energy companies. I have Organon, which is the healthcare spinoff from Merck. Lamar Advertising, that's the giant billboards. Those all have 6, 7, and 4% dividend yields. And those management teams, their whole goal is to return shareholder value in the form of a dividend. So you have to look for those. You can't just chase a high yield. And one of the things, too, people kind of get caught up on is the difference between dividend growth and dividend income. Those are very, very different things. So dividend growth, you could look at a company like Apple or Microsoft, Meta, Google. Those are dividend growth, right? They actually just started paying dividends. That's very different than what I own. So it's a strategy that works well for the right people. Yeah. Sorry, one more thing on that, or do you have a question?
Yeah, no, go ahead.
I'm rolling a little too fast.
That's all right.
Okay, thanks. Right now, I think when we do think about the outlook for 2025, and everywhere I'm reading, Goldman, Bank of America, JP Morgan, everyone's saying diversify out next year. And when we look at the S&P 500 right now, 10 stocks make up 39% of that index. That is really, really concentrated. When you look outside, and this isn't really dividend specific, this is whether you want to be in small cap or value, like anywhere that you get outside of the S&P 500, it's not as concentrated. And so if you do want to take a step back from that concentration, there are other areas. I would argue that the leadership of those 10 is not going to progress at the same pace it's been at for the past 5 years. So maybe there is relative, just not absolute upside in areas outside of the S&P 500, like dividend.